So we continue with latest banking, and now we are going to discuss Basel II. Basel II. So committee associated with Basel II is called BCBS. Committee associated with Basel II is BCBS. Basel Committee on Banking Supervision. Basel Committee on Banking Supervision. Financial crisis within financial services system can emerge anytime, anywhere around the globe, and it can impact other banking institutions also in other parts of the world due to financial globalization. Now, to withstand such crisis, the banks need to have adequate capital funds. So financial crisis within financial services system can emerge anywhere, anytime around the globe, and it impacts other banking institutions because of financial globalization. And to take care of such crisis, the banks need to have adequate capital funds, and Basel II relates to this part. What is the objective of Basel II? Objective was to strengthen capital base of the banks in relation to their risk-weighted assets. To strengthen the capital base in relation to risk-weighted assets. That is objective of Basel II. First report, that is Basel I, was in the year 1988, and it was implemented in India in March 1993. Second report, that is Basel II, it was in the year 2006, and it was implemented in India from 31st March 2008. And for some banks from 31st March 2009. So for foreign banks and Indian banks it was implemented from 31st March 2008, and for other Indian banks from 31st March 2009. So there was a system of parallel run also. So this parallel run, Basel I and Basel II, it was to be there up to March 31st, 2013. And banks were supposed to submit a quarterly report to their board of directors under copy to RBI. There are three pillars of Basel II which continue in Basel III as well. So three pillars of Basel II. First one is pillar 1. It relates to minimum capital standards. Minimum capital standards which are to be followed by banks. Second pillar relates to supervisory review by central banks. So in India it is to be done by RBI, supervisory review by central banks. Third pillar is market discipline. So this is through disclosure of information by banks. So disclosure and transparency. So first pillar, minimum capital standards. Second pillar, supervisory review. And third pillar, market discipline. First of all, pillar 1. Let us discuss pillar 1. So as we know, it relates to minimum capital standards. So these minimum capital standards are expressed through what? So these are expressed through capital adequacy ratio or capital to risk assets ratio. Capital adequacy ratio or capital to risk assets ratio. So it is calculated as capital fund divided by risk weighted assets into 100. Capital fund divided by risk weighted assets into 100. Here risk weighted assets include credit risk weighted assets, market risk weighted assets and operational risk weighted assets.